The housing market to get weaker, and the Fed's so-called angry birds won't be able to stop Ben Bernanke from more quantitative easing if that's what he wants. That's a word from Bank of America Merrill Lynch senior economist Meyer. She's a member of one of the most accurate teams of economic forecasters around, making her a Bloomberg best. She's at the B of A Merrill Lynch offices here in New York, joining us this morning. Michelle, welcome to InBusiness. You say the dissenters won't be able to stop Bernanke from carrying out quantitative easing, but you don't expect him to do that on Friday.
That's exactly right. I think if conditions warrant, which means a further deterioration in financial markets, continued weakening in the economic data, and fears of deflationary risks starting to kick in again, I think Bernanke is going to go ahead with whatever policy tools he sees fit, regardless of what the committee thinks. We already had 3 dissents in the last meeting. I think, of course, we could see that again if Bernanke wants to institute QE3 under this regime. But I think at the end of the day, Bernanke is going to do what he thinks is right to avoid deflation, avoid what happened in the 30s.
Do you think, though, that we've already gotten QE3 essentially by having the Fed promise to keep rates so low through 2013? I mean, that's unprecedented.
That's an excellent point, Margaret. I think you're right in that rates have fallen so much that, in effect, the market's already pricing in QE3 and also acting as if we're already receiving it to some extent. But I think the risk is that if we don't see QE3 and conditions continue to call for it, then you have an adverse reaction in the markets and the economy, and confidence really starts to sink. So it's not only that QE3 impacts the economy through lower interest rates and inflating asset prices, but it also helps through confidence.
So we've already seen, though, other firms, Barclays in particular today, highlighting that traders are betting between $500 and $600 billion in Treasury purchases will happen, that we will see active support. Why are they wrong?
I don't know that they're wrong. I just think it's a timing issue. I think they're wrong to expect it on Friday. For starters, Jackson Hole is a forum for economists. It's not a place to make policy changes. So Bernanke can't explicitly say that he'll do QE3. Of course, he could hint at it strongly. Right. But I think overall the markets are going to be disappointed if they think that Bernanke is going to outright say the economy needs quantitative easing. I don't think he'll say that on Friday.
Right, and it was that gesture towards quantitative easing, too, at Jackson Hole that got people to have heightened expectations this time around. But in your most recent note, you make an important point. Another point on the calendar we need to be aware of, October 1st. That's when discretionary spending funding runs out. Essentially, we may see another budget showdown in Washington before the Deficit Commission even has to go ahead with its cuts. Is this putting us in this protracted period of continual hits to confidence?
I think that's the fear, is that there's a lot of dysfunction in Washington right now, as we've seen the way the debt ceiling problem was handled did not exactly create much confidence in the markets or consumers or businesses. And it's not over yet. Not only do we have the Fiscal Commission that has to come up with a plan by the end of November, but we also need a new budget. And I think we could and should prepare for some additional confidence hit around that decision.
And along with that, though, should we be baking in further job cuts, particularly at the state and local levels, if we don't even have a budget at this point?
We should absolutely expect to see further cuts in the public sector. State and local governments have been slashing jobs over the past several months. Since the beginning of last year, they've cut an average of 20,000 to 25,000 jobs each month, and I think that trend will continue. In the summer in particular, we may actually see some elevated cuts in education because of a lot of layoffs in schools. And if you look at the Challenger survey, they showed announced job cuts for public education, and it spiked in July.
So is it that employment element that makes you say we're at a 40% chance of recession, or what is the tipping point? What's the trigger?
I think there's a number of things you want to look at before we can feel comfortable and say that we're actually going to see a recession. You need to see evidence that the decline that we're seeing in the survey data right now is persistent. It's not just a confidence shock that will fade. It's something that will actually feed into the rest of the economy and outright declines in output. So we want to see not only continued weakness in the survey data, but we actually want to see it in the hard statistics too. In particular, initial jobless claims, I think, is front and center. Also, the jobs report on September 2nd is going to be very important. If we see a negative payroll number or an increase in the unemployment rate, it would be very worrisome and further support that we could really be entering a recession. At this point, our baseline view is a 40% chance that we're entering a recession, which of course is quite elevated.
But what are some of those contributing factors that could put us that quote-unquote one shock away? I mean, how much does Europe and the lack of resolution as to its own debt crisis put us that much closer?
It certainly does. And here's where I think there's a lot of a big question mark, because it could very well be the case that the dysfunction both in Washington and in Europe could be that shock in some respect if it's self-fulfilling. So there's this idea of uncertainty shocks where businesses and consumers start to get worried about the future and the ability to reverse some of the plans that they're making today. So if they're concerned about future aggregate demand in the U.S., they may not invest today, they may not spend to get it today, and then that feeds into weakness in the overall economy, and it could be quite self-fulfilling. So it's something we really do have to worry about, and we have to look for signs of continued weakness and confidence on the consumer and business level.
Michelle, thank you so much joining us there from Bank of America Merrill Lynch this morning.